All right. So, continuing on with the rest of chapter 14, this section next talks about how to process 1099. Now, in this case, this could be applicable for those who are considering working for a company and or not so yeah working for a company who hires 1099 workers. In this case, I'm going to have you guys read this whole entire section on your own, just because this could only be applicable for those who do want to contract with those 1099 workers and have to file their forms and making sure that they get the proper payments that they receive, the proper 1090 8 forms, I believe they're called, to properly file the taxes. In this case, it's a long set of steps that you have to do for 1099 workers. And in this case, if you are not planning to work for a company or be a owner of your own company, once again, not everybody's going to consider 1099 workers. Again, it's depending on what you believe you want to have, if you can afford employees or not. Once again, this section is it's only in regards to people who are planning to have 1099 workers, okay? So this is not applicable for everybody. So I'm going to have you guys read this section on your own, and I think there's only like a few exercises that you can do. So again, you could do that on your own, just straightforward, just read through the rest of it because there's a lot more left I have to go through. Okay? So once again, I believe that's a couple pages long, maybe or so. So here we are. We're going to talk about managing equity. All right. So when we talk about equity, right, in terms of every different type of business organization will have a different title for equity, but they all do essentially the same thing, right? Equity, as we will learn, right, is pretty much the value of your company, right? It's the net worth of your company. What are contributing factors if you're a corporation, right? We call that stockholders' equity, okay? Because as a corporation, your funding or the means of gaining some kind of financial support is going to come from selling stock, okay? Because corporations, right? We understand that there are you can have millions of ownership, right? You have millions of owners. There's no one who actually just solemnly owns the company unless they own like more than 50% of the shares. Then they're considered the owner of the company. But in most cases, right, when you have some kind of corporation like that who rely on selling stock to get some capital going on, that's going to be considered stockholders' equity, right? However many stocks that they sell is going to determine how much money they can pull in for the company to invest into doing whatever they need to do in order to operate the business, okay? Same thing goes along the line for partnership and sole proprietors, except the difference here is sole proprietors and partnerships, they can't sell stock, right? They're not a publicly traded company. They are a smaller company that are limited to whatever investments that they put into their own company. So most starter up companies, either they get like a nice small business loan, or they have to dump a portion of their own money to, get their company up and running so they can operate and do business. But in this case, right, we're looking in aspects of three different types of organizations, right? We're going to look at sole proprietors, partnerships, and corporation. Now, for you guys, though, you do technically need a CPA in order for you to even touch anything that's in regards to publicly traded companies, okay? You need to certify in public accounting in order for you to be able to work for the corporations, okay? There are some rules around there where you can intern to gain your CPA, and once you get your license, then you can be a fully pledged person that's able to operate in the public platform or the public traded companies. But if you don't have a CPA license, then you are limited to either small businesses, even an LLC is borderline right there, and or partnerships. So in this case, the company that we're working for is Imagine Photography, and they're going to be using the word retained earnings. Retained earnings is a fancy word for equity, okay? Or net income equity, okay? It's the same thing as in sole proprietor, right? Owner's equity. Retained earnings is the same thing. So as you can see here, they even refer right here, if you are a sole proprietor, retained earnings is the same thing as owner's equity, okay? And that's what I need to show you here is that because the assumption here is that you're not going to be working for a publicly traded company unless you pursue a CPA or is on the way to get a CPA, then you need to be subject to these types of organizations, which is either a partnership or a sole proprietor. Now, most cases, the goal here is to take it slow because in order to grow as a company, you need to start from somewhere. And usually you would normally either start as a regular small sole proprietor or you could go into an LLC, all right? As long as you have the partners to go ahead and be able to file for the LLC, okay? So here, we're going to make sure that our chart of accounts has the accounts that we need. So in this case, right, we talked about that this is a corporation. So the equity accounts that you will see in Imagine Photography are going to be stockholders' equity, okay? As well as open balance equity, retained earnings, capital stock, and owner's draw. Now, in this case, this example here gives you owner's draw and owner's investment, right? As a means to go ahead so that we can practice doing the exercise with having the equity as owner's equity. Now in this case, we have opening balance equity, we have capital stock, we have owner's draw, owner's investments, partner 1 equity, this should be partner 1 draw, partner 2 equity, and so on and so forth, okay? So once again, the only thing that we have to do here is we need to rename retained earnings and have this considered to be your owner's equity. So again, if I right click on here, because this is a register, and I make changes to this account name, right? So instead of saying retained earnings, we're going to refer this as owner's equity. Okay. And I'm going to go ahead and save and close. Okay, so now I have an owner's equity count, I have an owner's draw, and an owner's investment. Okay. Now, when we talk about this, right? So now that this spreadsheet has all the accounts that we need to look at, right? We're going to act as if Imagine Photography is a small business, only has one owner, right? Mr. Jamal Williams or Vern Black. Doesn't matter, right? Let's just what the assumption here is, okay? So how do we manage our books, or we have what's called the closing process, is that at the end of a given period, right? You need to make sure that your equity reflects the way it reflects, okay? So in this case, right, if you choose to have extra investments or if you end up pulling out money from your checking account, you can do so, right? They don't, there's no rules on how you can take money away from your company, because if you're the owner of the company, you own the company. Everything that's in the company is yours. So you have every right and every means to take away from money from your company, or you can always invest your own money into the company again. Okay? So that's the one thing that I'm going to show you here is what if I decide to invest in my company once again, or Mr. Jamal Williams decides to invest some extra money into the bank account. So in this case, we're going to invest $5,000, okay? And how do we do that? Straightforward, pretty straight and easy, right? We go ahead and make deposits, okay? Now, if you guys remember from that one exercise when we got to take a look at our first deposit, right? We got to take a look at an example of how we can do an owner's investment, or in this case, right, invest more money into the company. So here we're gonna have the from accounts, right? We're going to deposit this from the investments account. Okay, so again, owner's investment is right here. Okay, now it says anybody that's receiving from, we're gonna receive this from Jamal Williams because he's the owner of the company. Jamal Williams. I do not see him on the list. What about Vern Black? I don't see him on there either. Okay, that's okay. If you don't see Jamal Williams, you could just add him in there. Right? Because he's going to be under the other names list. Right? Because he's the owner. So, once again, other list. Okay. Oh, oops. I accidentally hit on. Okay. So, once again, memo is going to be owner investment. Okay. It didn't go through. That's okay. We'll leave that part blank. Check number. Was there a check number written here in this case? I believe it was an EFT, but let's double confirm what your book says. Okay.
5416.
5416, right? And payment method is once again a check.
Check.
And the class is San Jose. And the amount is for $5,000. Okay. So now that we have that cleared up, okay, I don't know why I can't put that in there, but that's okay. It doesn't matter now. So once I have this, I can go ahead and click Save and Close. Okay. So if I actually go into my chart of accounts, let's notice this. If I go to my owner's investment account, so I'm going to put O. Okay. If I go to in my owner's investment account, I can see I have currently a $5,000 balance in there. Okay. And of course, my owner's equity right now, it's at 0. That's okay. All right. So now that I have that, now the next thing is what happens when I need to record the owner taking some money away. Simple. I simply just write a check out to the owner, right? In this case, I'm going to take it out of checking, okay? And this is to Jamal Williams. So once again, he doesn't exist in here, and I tried to quick add him, okay? There you go, quick add. He's a owner. So, okay. So there you go, Jamal Williams. All right. He's going to take some money out. So, owners draw. And that's the account that you're going to be taking it out from. Is you're going to insert this into owners draw. Okay, I'm in the wrong. Okay, there you go. Tab. Expense tab. Owners draw. Okay. And in this case, let's see how much money he's going to go ahead and take out. So, we're going to say
That's the one for 1,000.
For just 1,000,
Mm-hmm.
he's going to go ahead and withdraw $1,000 from the company. And the memo here, owner's draw. Right? He doesn't have to give you a reason why. Okay?
Didn't say anything.
Right, that's fine. Owner's draw. And of course, if the owner is going to take the money, he doesn't have to give a reason, and it doesn't have to go from a specific store or anything like that. So in this case, owner's draw for $1,000. Okay. Okay. So I have to sign another name, okay, so cancel. So in this case, I can't use this one. It needs to be, I don't know, 332. All right. Save and close. So now that it is saved, right? If I go to my chart accounts once again, right? Now I have an owner's investment of $5,000, and now I have an owner's draw for $1,000. Okay? So as you can see, it says negative 1,000, right? So in this case, this is what's called the closing entry, where you need to close out to equity, because in this case, that affects how my business is worth, right? If equity means that's how much my business is worth, right? If I invest money into my company, right? If I invest $5,000, that means I have $5,000 to either spend, or that's what my total assets should be worth. Okay? It should equal $5,000. Now, if for any reason the owner decides to take money away, that's going to decrease the value of your company because he's taking money away. Now, again, every owner has a right to pocket their profits. But once again, if you are a small business, you want to reconsider that, because if you're very small and you're not making that much money, you definitely don't want to take money out from your company, because you will end up having a loss, and your business isn't going to do well. So the best thing that you can do for your company is to just reinvest all of your money, so then you're constantly having money flow, or you have that extra money to reinvest into your company. Maybe throw in some fixtures, okay? Improvements for your company so you can attract more customers. There's a lot of reasons for that. So now that I have my account sets up, right, and I need to use my closing entry, this is where you're going to go ahead and make another journal entry, because we need to make sure that at the end of the day, when we close out our books, right, that we close them out properly by zeroing out our expenses, not expenses, excuse me, our equity accounts into equity. So as we remember, right, my retained earnings is now owner's equity. Okay, so in this case, right, when we talk about owner's equity, it's always credited. Now, in this case, it doesn't matter whether you have your credits or your debits first, just because it's QuickBooks. You know, as long as you indicate that it's debited or credited, it will go along the same lines as that. Okay, so in this case, my owner's equity, if I'm adding to it, then I'm going to be crediting my owner's equity. So in this case, I will be crediting my owner's investment, okay? And I'm going to credit my owner's equity, because I'm increasing my owner's equity, right, by $5,000. Okay? Oop. And I accidentally saved it because I pressed enter. So I'm going to go back to that previous one. So there you go. I didn't finish this one because this is just closing out to equity. Okay. you could do this, and then you could also include your equity here once again. So owner's equity, because in this case, right, I can also compute that also have to zero out my my owner's draw, because that's going to decrease my account by $1,000. So again, all right, and all of this is going to be the same thing here, closing out to equity. Okay, so I'm going to post that here, and I can post it exactly like this so that I can keep my transactions just as clear, or if I can do the math in my head, right, and have my debits match my credits. In this case, I would have my owner's withdrawal for $5,000. I would have my my owner's equity for $4,000, and I have my owner's draw for $1,000. That's also a way you could do it too. But in this case, because I already saved my transaction, I can't undo it, or I can undo it, but in this case, I don't want to undo it. So that's how I'm going to journalize this. And now I can go ahead and save and close this. Okay, yes. And okay. All right. So that's what you have to do when you are the sole proprietor. You own the company. So if I go ahead and do this real quick and check out my accounts, okay, notice this. My equity account, okay, for my draw is zeroed out, and my investments is zeroed out. Okay, but in this case, you're supposed to have $4,000 in your equity. Let me see here. And it says that we have this. Now, why is it that I have this amount in here? Because your retained earnings is already calculated your net income. That's one thing that you have to know as well, is that because your retained earnings, and that's the thing about QuickBooks, and that's the next thing that we're going to learn about here, is that QuickBooks would automatically do the closing entry for you. You don't need to close out your net income to your equity, because right here, it does it for you automatically at every single minute of your minute of the day. So that's how quick and how awesome QuickBooks is because it just saved you an extra adjustment entry that you have to normally do, which is to close out your books. All right, but in this case, right, when we learn how to close out our books, we need to close out our revenues and we need to close out our expenses into either net income or in corporate terms to the retained earnings. But because I renamed retained earnings as also known as owner's equity, it's already calculated all the net income that I've earned in that period. And here's my general journal saying that I increased my account by $5,000, but then I decreased my account by $1,000. So therefore, my total that's in my retained earnings is this amount right here, $21,617. Okay? And that's how you close out your equity. Okay? As a sole proprietor. And in this case, right, we talked about the closing entry. Right? That we talked about one of those are the list of things that you use a general journal for is to close out equity. But as we learn in this section here, if you read this section, not this one, this small section right here, you're going to understand that at the end of the year, you're going to have what's called net income, which is your total income subtracted by all of your expenses. And if you had more revenues against all your expenses and you have a positive number, that's considered net income. Now, if you had less revenues, but you had a lot more expenses, that's where you get a net loss. And this right here gives you your profit and loss, right? Once you get your profit and loss and find out what your net income and what your net loss or income, right? Whatever it is, it's automatically going to convert into your equity account, or in this case, your retained earnings. Okay, so QuickBooks saves you another entry for this section right here to close out the books for you automatically. So when you start the next given accounting period, you're ready to go. All right, and that is that section right there. Okay. Here is going to be a 11-step ways to how to close out your books. So again, we went through a lot of these steps, which is number 1, to record your cash, credit card, and whatever deposits, your loan deposits. You're going to adjust your inventory, adjust your depreciation. Other contributing factors are going to be to accrue any accounts, okay, for any other things that you have to do. So create your general journals. You also need to properly back up your company, and step number 9 is going to be to condense your files, and then you can go ahead and set the closing date as step 10. All right, and when you do the step 10 to set the closing date, which is the next thing we're going to talk about, it's very important that you do understand what that means. Okay, so there we have it. We talked about equity. Okay, now we're going to talk about setting the closing date. All right, and that's the last concept that we have here for today. All right, is to set the closing date, and of course we're going to practice on how to create our backup file. Okay, so what is the setting? What is the closing date? The closing date is another means to lock your data file. Now, when you lock your data file, that prevents anybody to go into your QuickBooks file and start making changes after you've locked up your data file. Okay? And this is a preventative measure so then you don't, have somebody, mess with the books, right? You don't have anybody messing with the books, changing transactions, so then you're reflecting nicer financial forms, okay? Because once again, anybody that has the ability to do that pretty much equals fraud, okay? So again, there are some rules and regulations on whether you can make changes in a closed period or not, which we talked about in chapter 11, okay, and chapter 9. But in this case, right, you definitely want to try to prevent the measures to try to secure your data as much as possible. Okay. Now, with that being said, right, what is setting the closing date is, in another sense, you're going to lock the data file. Now, in the very, very beginning of chapter 12, the first thing they asked you was to set the closing date. Now, in QuickBooks, my best recommendation to you is to wait till later. After you created your company file, I want you to wait till later to decide when your closing date is, because there are contributing factors such as when is your accounting cycle, okay? What is an accounting cycle? The accounting cycle is a series of process of steps that allows you to run the course of your accounting period, recording all the transactions, running your trial balance, running your financial reports, closing out the books, closing out your income and your expenses into equity, closing out the books, okay? And when we talk about the accounting cycle, we also have to talk about the accounting period. So when we talk about the accounting period, it means it allows you to break the accounting cycle, and it allows you to choose when you want to process, or in this case, close out your books every so often. Now, there are, so for example, right, major corporations such as Walmart, right? They throw out their quarterly statements, meaning they've run their books for a total of 3 months, and they gathered all their revenues, all their expenses, and they do all the reports and all the research and everything, right? And they close their accounting period every quarterly. Now, in this case, many corporations, depending on how big your company is and what makes sense to you, whether to close your business out every day, every month, every week, every year, it depends, as long as you do not go over a year. Because the purpose of creating an accounting period is to more or less have some kind of measurement of progress. Okay? And with that being said, right, it's in terms of creating your accounting period, right? If you do it every year, then you have what's called some kind of projection where you can determine what the outcome or what your sales, you could predict your sales by looking at the trend, right? This year, right, I made money. Last year, I made more money. And the year after, I made even more money, right? You're going to see some kind of, incline or decline depending on your business, right? You're going to see some kind of trend where is your business doing well or is it not doing so well, okay? And that's what we want to do when we close out our books, is to complete what's called the accounting cycle, which right here, those steps right here is to pretty much close out your books. So those 11 steps are what you need to do in QuickBooks to complete the accounting cycle, okay? Now, when we do that, right, and we talk about setting the closing date, that means from here on out, once we complete our accounting cycle, we ran our reports, and we decide to close our books completely, that means we can stop and then move on to a new accounting cycle or a new accounting period. All right? So creating this closing date just basically locks up your data file so that no one can make changes after the accounting period or after the accounting cycle is done and completed. All right, so that's why this is one of the last steps that you have to do in your in the 11 steps over there to close out your books properly. And let's go ahead and visit what how you are able to set the closing date. So in this case, right, there are 2 ways that you can set the closing date. Okay, you can do that by going to the company file on the menu, company menu, and then you can find it right here, set closing date. All right, and this window is going to look identical to by simply going to the edit preferences menu, okay, clicking on accounting, company, and at the very bottom you have the set closing date window. Okay, this is the same exact window that you're going to get by either going through the company menu or you're going to go through the edit preference menu. Okay, so here we are, closing date. Now, this is where I can go ahead and click set closing date, and you're going to get this window right here. Now, only the admin has the rights to close the date or has the rights to lock up the file, okay? Nobody should have access to this except for the admin, the person who created this company file, all right? No user can have the capabilities to do this. So that's why it's very important. As the accountant is the only one that has the information and should not give the password to anybody, all right? Because their sole responsibility is to make sure that they safeguard this company file and lock it up to make sure that no one else can go in there and change it, okay? So once again, you're going to choose an actual date, okay? Now, once again, if I chose today, that means at the end of today, my transactions will be locked until I click on a transaction and I put in the password to allow me to make changes to this file. But in this case, I'm not just going to close my my company file today. I want to close it towards the end of the year. And usually that's just a good, that's plenty enough time. So in this case, I'm going to go ahead and say I want this to be December 31st of 2025. Okay, so that means I have the next 4 years to close my books out. Okay. Now, again, that's because all the transactions that we were doing was as of 2025. Now, I'm just taking this into consideration that maybe I should close my books out either every month, at the end of the quarter, or at the end of the year. In most cases, the safest date that you want to choose is the end of the year. Okay? Now, once you've done that, you're going to have to create some kind of password to make sure when you lock your files, nobody has access to it unless they put in the admin password. All right? And in this case, they want you to just create a random password. So they do capital A, B, C, 1, 2, 3, 4 with a $sign. Okay? And they make you punch it in twice, so then you confirm. Okay? So capital A, B, C, 1, 2, 3, 4 with a $sign. Okay? And sometimes they'll have like security questions. In this case, this one doesn't. So I'm going to go ahead and click OK. So once I click OK, right, now, if this was if I closed it today, every transaction that I entered in here, I would have to be required to put in that admin password to verify that I am allowed to make changes to this workbook, all right, or this company file. In this case, I set my date for the future in 2025 in December 31st, which is the last day of the accounting period, okay? And that means when December 31st of 2025 comes around, right, it's going to lock up the transactions, so you cannot add anything more unless you have the admin password, okay? So now that I have that, I click OK. All right, and that's how you set the closing date. All right. And last thing that they tell you to do is just go ahead and consider using the condensed data file. Once again, I'm not going to do that, but I am going to teach you how to do a backup file, because that's one of the things that we were supposed to do before you go ahead and condense your data file. So once again, you're going to go to File, and you're going to go ahead and click up Backup Company, all right? And I'm going to create a local backup, okay? You don't want to restore a previous one or set up another one, okay? You just want to make sure that you click on Create a Local Backup, meaning you're going to make another file on the same hard drive. That's all it means, okay? So once I do that, I'm going to get this option here. First, I need to designate a space. In this case, I'm making a local backup. I'm not going to do an online backup just because I don't think it's necessary unless you have an Intuit cloud space, right? If this is a legitimate owned license, then you're going to have the accessibility to have the online service for you. But in this case, I'm doing a local one because I want it on my hard drive. Okay. If you click on the options down here to change basically where you want to have your backup placed, right? You can always set up where you want it to be placed. Okay, so in this case, I'm going to go ahead and browse my my files here, and I'm going to put it in the same folder as my as our class, right? In the accounting, under QuickBooks class, under portable files. Okay. Oops, portable files. All right, under your class. And I'm going to click OK. Now, sometimes they'll give you an error message saying that you can't use this local backup. You need to find another place for it. If that's the case, just go ahead, save this spot anyway. All right. Now, questions that it's going to ask you is how often do you want to have the number of backup copies in a folder? All right. So you can cap how many backups you want to have. In this case, I'm going to say maximum I want is 10. All right. Now, the next question is going to ask you, well, if you are doing a local backup, how often would you like to have the backup done? So if you're using QuickBooks in the 8-hour period that you're working, right? You can set it up so that as you, as you enter your transactions in QuickBooks, you can automatically schedule a local backup to happen in the background, all right? And in this case, right, I'm going to say I only want one backup a day, all right? And that will be at the end of the day. You can even schedule the time, but in this case, I just want to say I only want it done once, all right? Now, do you want to complete the verification, which is recommended, or do you want to have a quicker verification or no verification? Now, again, they recommend you to have a verification, so verification is more so when you have to enter in your credentials, or verification is when you exit QuickBooks, right? It gives you that pop-up message saying, hey, would you like to back up your file, right? In this case, I'm going to leave it as complete verification, and I'm going to click OK. So once you get that, you're going to get an error message saying that you've told us to save the backup copy in this file located there. This is what I'm talking about. I'm going to say, I don't care, use this location. So now I save those changes and I can go ahead and click next. So then now it's going to say here to me, do I want to save it now? Do I want to wait till the end of the day and schedule the actual time for when I want the backup? Or do I actually want to only schedule future backups? So in this case, I don't want to save it today. I'm going to save it now. Okay? I don't want to schedule it. I want to save it now. So then I click next, and once again, it's in the folder that we designated it, which is the our class right now. And if you notice this is what the backup file would look like. It will give you a timestamp, the date stamp, and it will tell you which backup file this is. So it'll tell you backup number 1. Okay, and it tells you backup for July 27, 2020 as of 4/13. So it gives you a time and date stamp. Okay, yes, you can go here and modify it if you'd like, but this is the best way so you know exactly when you backed up this file. All right, and I'm going to click save. So now it's not closing my file. It's just wrapping everything up and saving it up and creating a backup file. All right. Once it does that, it's just going to reopen again. Okay. So there you go. I created my backup file. And if I go into my folder to locate where that file is, it's going to show me, let me see here, that, what was this one? This one was adjustments. It's going to be under adjustments, backup file. Okay, there you go, adjustments, backup file. Did I name it as adjustments backup file? Or I just named it as backup file? I don't even remember. But
It's in the first one right there, adjustment 21. That one.
no, because I've saved it as the time and date as well.
No.
So in this case, oh wait, actually that would be, yes. This the sand something right there. Yeah, that's the backup file.
4:01 p.m.
4:01 p.m. Yeah. So that's where you're going to locate it, right? I put it into this file exactly right here. So that is it, all right? Any questions in regards to chapter 14? There was a lot of information, okay? Any questions?
You just gotta go back and redo everything.
Now, for those who haven't gone through the accounting program, a lot of this is probably gibberish to you because I used a lot of, terminology like closing the accounting period, etc., etc. That's just what you have to do as a general ledger or general accountant. You have to close out the books, and this is how you do it. Okay? All right, if you guys don't have any other questions, let's go ahead and dive right into the review questions, okay? Multiple choice section. Again, you're going to select the best answer for each of the following, okay? Number 1, which of the following tasks does QuickBooks perform automatically at year end? C. Okay, you're going to adjust the balances in the retained earnings account to reflect the net income or net for the end of the year. Yes.
Yes.
Okay, so that is correct. Number 2, entering a date in the closing date field, okay, accomplishes which of the following tasks? C, right? Always refer to closing the date is as if you're locking the file. So again, locking the data file so that nobody has access to enter in any transactions after the dated amount. Okay? Okay. Number 3, voiding and deleting transactions. Okay, both do the following. So we're looking at what they both can do. C, zero out the debits and credits in the specified by the transaction. Okay, so in this case, D, you said D, B, and C. Okay, B says to completely remove all details in the transaction. Now, can voiding completely remove everything?
No, there's the history.
Correct. It doesn't delete any information. It keeps all the stuff there except it just zeroes out the account. So in this case, we're looking at what both the voiding and both deleting can do. Okay? So again, voiding keeps the transaction information. Deleting completely removes it. But what they both do is they both zero out the accounts. Number 4, to make an adjustment to items as well as their associated accounts, create a
C.
$0 check. That is correct, right? Okay. Number 5, at the end of the year, you should perform the following. D, all of the above. Yes. Okay, so this is under the list of the 11 things that you have to do to close out your accounting period, right? First one is enter depreciation, of course. You need to perform a physical inventory. Yes. To adjust it, okay? And if your business is a partnership or a partnership, you're going to enter a general journal to enter in the profits that you're going to distribute for each partner. Okay, just to sum up. Good. Number 6, okay, to track payments to a 1099 vendor and then print out a Form 1099 accurately, you must complete all of the following except B as in boy. Yes. Enter in the vendor's account information on the address information. Yes. So once again, that whole section, I skipped that whole section because once again, Not everybody's gonna have a 1099 worker. So if it works for you, then go ahead and read that up. But this is something that you're supposed to know and read in between that. Okay. All right. Number 7. The IRS may reject the 1099 that you submit if.
C.
C.
So number
C.
7, C, if the taxpayer ID is incorrect. So yes, if you read in between that small section, there is a small section where you need to verify that this person is a legitimate 1099 worker. Okay? So if you guys remember way back when we did chapter 4 and we entered in Boswell Consultant, they were a 1099 contract worker, right? And for us to put the purpose of putting their social security number in is to verify that they are an independent contractor. Because if they go through this system and the IRS sees that this person is not a 1099 worker, they can get into trouble with us. And you can also get into trouble with this as well. Okay? So yes, there's a verification process that you do have to confirm that 1099 workers are indeed 1099 workers.
Well, the ID is for every taxpayer, no?
Well,
reject.
Well, no, because if the person, right, you have to when you are an independent contractor, you do need to make sure that you do the 1099 form and say whether you are a self-employee or you are a 1099 or an independent contractor.
Independent, yes.
And when you submit that, then the IRS knows that when you file for taxes, you are either or. So in this case, because you are going to be responsible for submitting your own 1099, right? The company is also responsible to print out that 1098 form that gives them all their W-2 form information. Okay? Not W-2 form, but you know what I mean, right? All the taxes, all the earnings that this person has done for your job, for the company.
Thanks.
All right. Number 8, by creating a special bank account called General Journals, what does it do?
A.
A.
Okay.
Agency journal entries account. Yeah.
Correct. A is correct. Okay. Yes, it's a quicker and easier way to find and locate all your general journals. So by creating that bank account, right, you have a register, and by clicking on that, you can find all your general journal entries. But that's only if you enter in general journals entries account first thing before you start your general journal. Okay. Number 9. When you purchase a fixed asset, you should code the purchase to
A.
the fixed asset type account. Okay, good. Now, fixed asset type account. Yes, you need to have the account first before you can put it on the fixed asset item list. All right, so yes, A is correct. Number 10, okay, which of the following is not true about 1099s?
D.
D, you will not include payments made to contractors. C is the correct answer, so D is not right. Okay, because it says you will not include the payment made, which, yes, you will, right? That's true. That's not true. Okay. C, on the other hand, says that the 1099 wizard helps you prepare 1099 miscellaneous, 1099 NT, and 1099 DIV forms. No, it does not do that. I believe you only see the 1099 MIS form, but you don't see the other two. Okay. So once again, that whole section on processing the 1099s, this is where you're going to find that information on what you can process and what you can't process. Number 11. Which of the following is... Wait, hold on. That question was true. So yes, you will be able to process all three. Number 14. Which of the following is an example of a fixed asset?
A.
Okay, A $5,000 high-speed copier. Yes, right? Because it's a copier. Now let's look at the other two. Other two. A $2,000 laptop computer. Okay, so in context of QuickBooks, a computer lasts a pretty long time, whether it's $2,000, because in this case, they tell you that a fixed asset would be anything that's over $2,500. And in this case, that's just, that's corporate terms, right? Because anything less, especially on a corporate's budget, anything less than $2,500 is pretty much scrap change, right? But if you're a small owner, every asset that you purchase is whether it's fixed, is definitely going to be depreciable. Now, again, when we talk about materiality, right? If you buy a $5 trash bin, would you put that under a fixed asset? Is $5 significant enough for you to overstate your assets?
No.
No, it's so small. So in that case, you're better off just expensing that item. But if you buy a $100 machine, in that kind of context, yes, you should depreciate it. But in QuickBooks, the reason why they have that cap of $2,500 is because that's the law for corporate. Okay. Again, a box of paper. Obviously, a box of paper is going to be a supplies expense. Okay. Number 12, last question. Which of the following is false?
C.
C. General journals entries are used to reassociate funds, okay, from one to another item. Okay, in this case, not really, because general journals are usually to be able to move from one account to another. The $0 check, on the other hand, you can take expenses and distribute them into items. So in this case, the correct word here is supposed to be, to make it true, is that it's supposed to be a $0 check, not a general journal entry. Okay? The rest are true. So going back to that one question.
Which one is the right one?
What?
Which one is the right one in number 12?
Number 12 is C.
C.
C. I proved this one was wrong. Right? Because the question was asking which one's false. The correct answer would be $0 checks. Allows you to reassociate your expenses into items. Okay? Not general journal entries. General journal entries are strictly between accounts to other accounts. Okay. Okay, so going back to question 10, the correct answer is C. This statement is true. Because I remember you do help process file all three forms. So that statement is true. All right. So again, I'm going to have you guys do the fill in the blank on your own. Again, any questions in regards to chapter 14?
No.
Okay.
No.
All right. So again,